Welcome back to Simply Wall Street's Market Insights. This week, we find ourselves in the third quarter and second half of 2024. Equity markets have done better than many expected, despite interest rates remaining elevated. Yes, most of the heavy lifting has been done by big tech, but the outlook for the broader market has actually improved. This week, we're looking at what's been happening under the hood across equity markets, as well as looking ahead to the second half of 2024. The quote of the week from Kenneth Fisher: "I've done well over time, but made lots of mistakes too. Learn from your mistakes." In the markets this week, first up, US short-term borrowing set to increase dramatically. Our take: the fact that the US budget deficit keeps growing shouldn't be news to anyone. The timing of the actual borrowing, when the Treasury needs to issue and sell new bonds, is more complex. This depends on the exact timing of maturing bonds that will need to be rolled over, as well as major expenses like the recent aid packages to Ukraine and Israel. The Treasury is also selling more short-dated debt instruments than normal, presumably because it expects rates to fall. To add to the complexity, some funds can only invest in short-dated debt, while others can only invest in longer-dated debt. Some analysts are expecting a big spike in short-term borrowing in the next 3 months, which could put strain on liquidity. That probably won't be a problem unless there are other crises at the same time. Next up, judge rejects Visa and MasterCard's $30 billion settlement on swipe fees. Our take: in March, Visa and MasterCard proposed a deal that would slightly reduce the fees they charge merchants. A judge has now put that deal on hold and is likely to reject it. $30 billion might sound alarming, but it was actually the estimated amount merchants would save over the next 5 years, after which the deal would expire. The actual reduction in fees was 0.04%, which is quite literally a tiny fraction of what they charge merchants. The companies will likely need to improve their offer, but it's unlikely to have a substantial impact on their respective earnings. Online fashion retailer Shein files for London IPO. Our take: Shein, which was last valued at $45 billion, originally filed to list in New York in 2023. That filing ran into trouble as it coincided with negative publicity over working conditions at several Shein suppliers in China. Shein is now based in Singapore, but began in China, where most of its suppliers are still located. Companies with links to China are finding it increasingly difficult to do business in the US. This is likely to lead to even more creative arrangements with companies based in connected countries like Vietnam, Indonesia, and Mexico. Up next, Amazon to launch discount store to take on Temu and Shein. Our take: it's been a busy week in e-commerce. Days after Shein announced its London IPO, Amazon pitched a new budget storefront to sellers in China. How those sellers might differ from Shein remains to be seen. The Everything store seems to be under pressure after the growth of Temu and Shein in Western markets. Also in the world of e-commerce, Target is teaming up with Shopify to expand its third-party marketplace. The bottom line: retail is a brutal industry and margins are seldom safe. Up next, Europe green power deals set for a strong year. Our take: we recently wrote about wind and solar energy. From an investor's point of view, green energy has been a disaster until recently. But 2023 was a record year for new green energy capacity additions. 2024 is shaping up to be another record year, particularly in Europe. S&P Global Commodity Insights reported 145 new deals between January and May, compared to 94 in the first 5 months of 2023. Electricity prices have fallen dramatically, so the winners might end up being suppliers and consumers rather than utilities. Next, Benedict Evans on Apple Intelligence. Our take: Evans recently posted an essay on Apple's AI strategy. One of the things he pointed out was that Apple's approach: workloads will be unbundled into individual features, which are inherently easier to run as small, power-efficient models on small, power-efficient devices. This pushes the cost of inference to the user, which could completely alter the economics of AI applications. The essay is worth reading if you're trying to understand who the winners and losers in the AI arms race might be. His previous essay on building AI products with buggy LLMs is also a good read. Lastly, the consensus on tariffs is changing. Our take: Axios wrote an interesting deep dive on the shifting attitudes to tariffs. The pro-capitalism view has always been that tariffs make imports more expensive for consumers and punish low-cost producers. This is all true, but it became a lot more complicated with subsidies, IP theft, and wide-ranging strategic objectives. But, as Axios points out, trying to advance a number of totally separate goals is a lot to ask from trade policy. Now into our main piece for today, second quarter and half-year review. For most economies, the soft landing scenario has continued to play out in the second quarter. The IMF has made far fewer changes to its GDP growth projections than it did in 2022 and 23. The IMF expects global growth to remain at 2023's level of 3.2% through 24 and 25. However, they expect this to include a slowdown in the US and Asia, offset by accelerating growth in Europe and non-Asian emerging economies. Inflation across the globe has either fallen or stabilized, which has led to improved confidence and taken the pressure off corporate profits. Lower inflation expectations and fewer mentions of recessions does a lot for business and consumer confidence. Central banks have begun to cut rates in the economies where inflation is close to target levels. However, stubborn inflation in the US, UK, and Australia means rate cuts have been pushed further into the future. Bond yields in a lot of countries peaked in April or May, but they remain at elevated levels. The AI and big tech themes have continued to dominate equity markets through the second quarter. Indexes with exposure to the Magnificent Seven have outperformed across the board. Elsewhere, equities have made modest gains, apart from certain markets where unique factors are at play. The performance of country-specific benchmark indexes paints a different picture, with plenty of markets in the red for the year. Most of the variation can be attributed to three things. Firstly, some indexes are becoming very concentrated. For example, TSMC now makes up nearly 30% of Taiwan's index. China's various indexes also appear to contradict one another due to slight differences in composition. Secondly, the economic slowdown in China has affected its trading partners in Asia. But once again, the indexes reflect the performance of the largest companies, not necessarily the entire market. And lastly, recent political events have led to volatility in Mexico and France, which erased gains made earlier this year. North America. US equities have benefited from rising earnings across most sectors. Despite rate cuts being pushed further into the future, most of the index gains have come from big tech, and small cap indexes are in negative territory year to date. There are smaller companies that are performing well, but there are a lot more that are underperforming. In Canada, corporate earnings have fallen significantly in the last 18 months due to falling revenue and margin pressure. But earnings are now declining at a slower rate, and investors are looking beyond the current profit slump. Valuations appear high, but will look more reasonable if or when earnings do rebound. If you think that'll occur, then today's prices might be appealing to you. Over in Europe, Europe's economic recovery has been slow as the continent dealt with high energy prices, high interest rates, and low export demand. The outlook has improved as energy prices and inflation have fallen, and the ECB has made its first rate cut. Corporate earnings have begun to improve in some cases or stopped falling in others. The chart below reflects a sharp recovery in earnings for companies in France. Beneath the surface, the trend in profits varies widely across different sectors and industries, and this is the case for most European markets. If you head to the markets page, you can view charts like this for each country, as well as sectors and industries within the market. These charts provide valuable insights into the historical trends and investor sentiment. Looking forward, improving GDP growth and lower relative valuations may support European markets. In Asia Pacific, India and Japan continue to stand out in Asia, with rising corporate earnings and strong underlying fundamentals. However, momentum has slowed and Japan's index slipped in the second quarter. Elsewhere in Asia, performance has been sector, industry, and stock specific. Korea, shown below, is now experiencing a recovery in earnings, while earnings in other markets have begun to decline. There appears to be a fair amount of mean reversion and rotation between markets in Asia. Australia and New Zealand's economies are struggling under the pressure of high interest rates and stubborn inflation. Higher prices and mortgage rates have resulted in lower consumer sentiment and spending, at a time when export demand from China is also lower than hoped. These economies could really do with several rate cuts to improve sentiment. Over to the insight for this week. Heading into the third quarter with a Goldilocks economy. The term Goldilocks economy refers to a situation where economic growth is neither too hot nor too cold. In other words, growth isn't high enough to cause inflation, but it's also steady enough to keep sentiment and investment at healthy levels. Stock prices often do quite well under these conditions as expectations aren't too high and things keep turning out to be a little bit better than expected. At the moment, we have several positive and negative catalysts to consider. On the positive side, we have inflation, which has fallen dramatically, although still higher than target rates. The expectation of a recession has faded. Earnings are recovering in some markets and falling at a much slower rate in others. Geopolitical concerns have eased. The risks remain but seem less present. More attractive relative valuations could lead to rotation in lagging market, including small cap value stocks, European and emerging market stocks. This would be healthy for markets and lead to less concentration in a handful of very large companies. On the negative side, economic growth is slowing in leading economies. Upcoming elections in the US, UK, and Europe are causing some nervousness. Rising populism could result in more protectionist policies as well as uncertainty. Recent elections in India and Mexico didn't go the way some investors hoped. There's a growing fear that the current cycle of AI-related investment could end quite suddenly. What would that mean for big tech valuations and the broader market is uncertain. These positive and negative catalysts are quite well balanced. There are a few risks, but investors are usually rewarded for taking on those risks. Heading into the second half of 2024, it's as important as ever to be diversified across several industries and also sticking with higher quality companies. The higher for longer scenario is playing out for interest rates, and that means lower quality speculative stocks remain a risky proposition. If you are looking for offshore diversification from your local market, a lot of exchanges include dual listed companies. These are companies that are listed on a market but based in another country. You can find these using the Simply Wall Street Stock Screener with the following steps. Select your country or exchange under the Filter by Market tab, click Edit on the Advanced Filters tab, scroll to the last section and turn High Secondary Listings off and turn Show Companies with Currency Different to Exchange on. Key events to pay attention to this week. In particular, there are 3 employment reports due this week. Monday, China's manufacturing PMI will shed more light on the state of China's economy. The index is forecast to fall slightly from the previous level of 51.7. Japan's Consumer Confidence Index is expected to fall from 36.2 to 36. The US PMI index is expected to be up 51, up from 48.7 in the prior period. On Tuesday, France's preliminary inflation rate will be released and is expected to fall to 2.4% from 2.6% in May. The US jobs report will be published. In April, job openings fell to the lowest level in 3 years, and this report is being closely watched as the labour market begins to show signs of a more pronounced slowdown. Wednesday, the US ADP employment report is expected to show private businesses adding 100,000 new jobs, down from 152 in May. The minutes from the last FOMC meeting will be published. Thursday, the UK general election takes place. 1 week out, the odds of Rishi Sunak keeping his job were 33 to 1. Friday, US non-farm payrolls are forecast to be 160,000, down from 272,000 last month. The unemployment rate is expected to be steady at 4%. This week, most of the corporate world is taking a break ahead of earnings season's kickoff on July 12th. There are no major companies reporting, although lots of small cap and over-the-counter companies are scheduled to report. That's all for this week's Market Insights. Thank you so much for listening, and until next week, invest well. Simply Wall Street analyst Richard Bowman and Simply Wall Street have no positions in any of the companies mentioned. This recording is general in nature. We provide analysis based on historical data and analyst forecasts, only using an unbiased methodology, and our articles are not intended to be financial advice. It does not constitute a recommendation to buy or sell any stock and doesn't take into account any of your objectives on your financial situation. We aim to bring you long-term focused analysis driven by fundamental data. Note that our analysis may not always factor in the latest price, sensitive company announcements, or qualitative material.